So, a payment company is trying to become a full-fledged bank. That sounds like a seismic shift in the financial world.
Indeed, it's less about lending money and more about owning the plumbing of finance, and that's where the real power game is about to start.
Welcome back, I'm Bella.
And I'm Michael. This show's scripted and produced with AI, built by Taha Baba, pulling today's stories straight from blog.tahababa.com.
If you want these landing in your feed most days, go ahead and subscribe. Let's get into it. So, Klarna is applying to create an FDIC-insured bank in Utah to handle all their lending and payments infrastructure. That sounds like a massive pivot for a fintech company.
It is a significant move, Bella. The primary driver here seems to be consolidation, reducing dependency on partner banks and hopefully lowering those funding costs. It's a strategic attempt to gain full control over their financial products.
Exactly. It really highlights how much the industry is moving toward regulatory ownership. Do you think this changes the traditional relationship between fintechs and established banks quickly?
I don't think it will change overnight, but it certainly sets a powerful precedent. It underscores that regulatory ownership is becoming a key competitive advantage for anyone looking to disrupt the financial services landscape.
That makes sense. It's less about building a better app and more about building the necessary legal and financial infrastructure to compete effectively. It really forces incumbents to adapt. So Fiserv is looking to sell its entire Star Network debit card infrastructure to major banks like JPMorgan and Bank of America. That sounds like a massive consolidation play in the payments world.
It definitely is. Giving large banks control over debit routing could significantly help them navigate those federal debit card fee caps, which is a huge regulatory lever.
But that raises some serious questions about who controls the system. Are we talking about greater efficiency for the banks or potential issues for merchants?
The pushback from merchants is going to be significant. If a few institutions dominate debit routing, the long-term implications for smaller businesses and consumers need careful examination.
Exactly. It really highlights how critical infrastructure ownership is becoming in this space. It seems like the battleground is shifting from services to the underlying technology itself. So Coinbase just got a UK MiFID license, which is a huge step for them, allowing them to offer equities and derivatives alongside crypto.
It's less a license and more a validation of the everything exchange vision. It officially bridges the gap between digital assets and traditional finance for UK users.
That really makes sense. It shows that this integration of traditional and digital assets isn't just a theoretical idea anymore, it's operational.
Exactly. For crypto-native firms, this is a significant nod that their multi-asset business model is viable, provided they navigate the regulatory landscape correctly.
I wonder how this convergence will actually shape the next generation of financial platforms overall.
Well, if things go smoothly, we might see a future where traditional and digital assets are just different layers on the same platform, which is certainly a more interesting thought.
I was reading about Privy, and this idea of making crypto buying feel as easy as buying a coffee. It sounds like they are really tackling the friction that stops people from getting into crypto.
It's a fascinating application of financial engineering. They aren't building a new exchange. They're building the bridge, leveraging Stripe's infrastructure to eliminate the tedious step of separate account creation.
So the real innovation here is just making the transaction seamless, letting you buy crypto directly inside the app with a card. That really changes the user experience for newcomers.
Exactly. It shifts the focus from managing complex wallets to simply making a payment. It proves that reducing onboarding friction is often the most powerful lever for driving broader adoption of any service.
It makes sense. It puts the focus back on the utility rather than the bureaucracy. I wonder how other fintech companies can copy this approach to reduce their own onboarding hurdles. I was just reading about Alipay upgrading their TAP devices into an AI agent network for offline business operations. That sounds like a massive shift for physical retail.
It certainly is. Embedding agentic commerce directly into physical retail environments is a huge step, moving AI out of the purely digital space and into tangible commerce.
So, this is essentially creating a large-scale system where every physical interaction becomes an opportunity for intelligent automation.
Precisely. It suggests that for businesses still relying on traditional systems, the choice is stark: modernize quickly or risk falling behind this new wave of intelligent automation.
It makes you wonder how quickly brick-and-mortar stores will have to adapt their point-of-sale systems to keep up with this pace. So, Norm AI just raised $120 million and is valued at $1.2 billion. But the real kicker is how they're approaching the legal market.
It's the valuation, sure, but it's the model that's genuinely disruptive. They aren't just selling software to law firms. They've created their own law firm, Norm Law.
That flips the script entirely. Delivering services directly with outcome-based pricing really challenges that old billable hour paradigm.
Exactly. It forces a conversation about whether outcome-based pricing can actually scale across the entire professional services industry, or if it's just a niche experiment.
It makes you wonder if clients are ready for that kind of transparency and accountability in legal services moving forward. So, Google Cloud is physically hosting Gemini models in India now. That sounds like a massive step toward AI residency.
It is. This moves the conversation past simple data residency into AI residency, which is a much more complex legal and technical hurdle for global enterprises.
Exactly. It's about ensuring that the processing and the data stay within specific sovereign borders, which should significantly reduce compliance friction for regulated industries.
Right. The real challenge now isn't just where the data lives, but how organizations manage that tension between maintaining global scalability and meeting these increasingly strict regional compliance demands.
It really puts the onus on companies to figure out how to build distributed AI systems that are both powerful and compliant simultaneously. This idea that AI isn't creating entirely new threats, but just magnifying what we already have sounds incredibly worrying.
It really boils down to technical debt, Bella. AI is just the force multiplier exposing the organizational weaknesses in how we manage that debt, particularly governance and failure asymmetry between teams.
So it's less about the technology itself and more about the human and organizational structure around it. How does that translate into a crisis?
It means that as AI adoption speeds up, the gap between innovation and security maturity widens rapidly. The real question isn't if a breach will happen, but when the accumulated debt will force the crisis to arrive.
That makes perfect sense. We need to figure out how to align that AI innovation with security frameworks before that debt becomes unmanageable. And that brings us to our rapid-fire round for you.
Let's dive into the latest headlines.
Visa is expanding beyond payments with its new mobile-first travel platform.
Anthropic's Claude Cowork is now available on web and mobile.
OpenAI's GPT Live enables real-time voice conversations in ChatGPT.
Microsoft is making settings backup by default for organizations in Windows.
PyPy Trusted Publishing doesn't guarantee package safety.
CISA added 3 new vulnerabilities to its known exploited vulnerabilities list.
Trust issues are rising among charities using AI.
OpenAI's GPT Live allows simultaneous listening and speaking in ChatGPT voice.
The rivalry between Anthropic's Fable and OpenAI's Sol is heating up.
OpenAI acquired Northslope to strengthen its enterprise deployment capabilities.
Prime Intellect raised $130 million for training companies' own agentic systems.
78% of enterprises report AI-related security incidents or vulnerabilities, per a DigiCert survey.
AI-ready data is becoming a competitive advantage as enterprises move from experimentation to production.
AI is enabling more convincing and scalable social engineering attacks on enterprise service desks.
Hugging Face models are now supported on Microsoft Foundry Managed Compute for enterprise hosting.
Minimax is reportedly developing a 2.7T parameter open-source model to challenge pricing in the AI model market.
Anthropic committed $50 billion to new U.S. data centers, including facilities in Texas and New York.
Microsoft is reportedly replacing some OpenAI and Anthropic model calls with in-house MAI models in Copilot apps.
HubSpot scaled its vector-as-a-service platform to a production semantic search layer with over 20 billion vectors across 200-plus indexes and 140-plus clusters.
Apache Iceberg v3 introduced a variant type to optimize JSON analytics by shredding semi-structured data into Parquet columns.
AI agents in data engineering require a correctness layer with deterministic validation to ensure production reliability.
A 3-layer framework for building reliable AI agents was proposed, separating model, harness, and configuration layers. That's today's show, scripted and produced with AI by Taha Baba.
You can read the full write-up anytime at blog.tahababa.com. And if you want these landing in your feed most days, hit subscribe.
See you next time.